Next is DDM, but this time we're going to have growth, 3% first and then 6%. So let's start with the formula. The formula is dividend 1 divided by RS minus G. The growth rate is 3%. So div for time 0 equals 2. So div for T1 equals that times 1 plus the growth rate of 0.03. And therefore, the value equals, I'm doing this in steps just to make sure you don't make that same mistake. So you take T1 divided by the required return, which we saw up here, 13%, 0.13 minus 0.02, or 3 rather, and we get $20, okay? So that is the value where we use dividend of T plus 1 divided by R minus G. And to keep notes, here's where we could do it right here. Next, we would do 6% growth rate. All right, so the dividend in T1 is now, let's do this from scratch, T0 times 1 plus growth rate 0.06. So the growth rate is that value. Again, we'll just do that from scratch. We take T1 divided by the WACC of 0.13 minus the new growth rate 0.06. And so that is 30.3, 30.29. Okay, that's quite a different number. And the last question is, how sensitive is valuation to the growth rate? Well, observe that at 3 it's 20 and at 6 it's 30. So answer is quite sensitive, right? How sensitive is it? It's extremely sensitive to long-range growth. Something as powerful as the G is something that makes sense because we're looking at growth forever. And whether you're growing 1% forever or 3% forever seems like nothing, but forever is a long time. And this is what happened here. We started 3, gave us $20, gave us 6, gave us $30. So it's an important observation about any time we use this kind of dividend growth model. All right. Next, we'll look at components of return. We saw this in the last chapter when we looked at components of return as we're doing risk and return measurements. But here, we're using it in the context of valuation of using DDM. We have these relationships we've seen. The price of today equals dividend next year divided by R minus G. And we could rearrange the terms to get that the return is equal to this factor, which looks a lot like dividend yield, right? Dividend divided by price plus the growth rate. So this is the observation, is that we can have the required return equals dividend yield plus a capital gains yield. So how do we use that? We can then look at DDM at the end of year 1 and then do those calculations of how much of that yield came from dividends, how much of the yield came from capital gains, and therefore what's the total return. So here's some data. Company A has a beta of 1.2, risk rate of 7, MRP of 5. That sounds familiar. We just used that. And at time 0, a dividend of 2, and we're using 6%, which was that second scenario that we did. So now let's project the price at the end of year 1 and measure the return at the end of year 1 for dividend, capital gain, and total. And we will do it in Excel, right? So we'll break out and create this model. So first, we could say, what is the price per share at time 0? So that's 30.29. We got that just in the prior section. What is the required return? That was the 13%, and that's based on WACC. And here's the new part. So what is the dividend at the end of year 1? We had dividend of 2 equals 2 times 1 plus 0.06. dividend for year one. What's dividend for next year? It's plus the current year, again, times 1 plus 0.06 again. So it's one more year. And the price at the end of year one equals the dividend for the following year, which is this number, divided by, open parens, the required rate of return, 13 minus 0.06, which is the growth rate. So that's our handy new formula, which is value equals dividend for next year divided by the required return minus the long-term growth rate. So now we have all we need. Dividend yield is equal to what dividend we got this year, 212, divided by the original price. So we paid $30 for the stock, and so therefore the yield is 212 divided by $30. And the capital gain, well, capital gain itself equals, I am now, or the stock's now worth 32. How much was it worth? 30. So we made $1.82, and $1.82 divided by a base of 30 means we had a capital gain of 6. So the total return in percentage terms is 13%. All right. So that is the price per share and the breakout of the yield, the total return, into dividend and capital gain portions. So this is a graphic. If we did this every year, for not every year, but for years 1, 2, and 3, what would we see? We just derived this set right here, the 3210, and if we went out further, what we see is that it's constant, 7 and 3, and the bottom is the depiction of what if we took the present value for the 3 years of cash flow from dividends, and then we compared that to the value of the long-term gain. And what we see is that 82% of the value of this company is derived from the capital gain, and only 17% is derived from the present values of dividends. And this is an important observation for most companies, is that although companies may pay dividends, when we look at its long-run value, it is basically from capital gain. That there is some degree of dividend yield, but it's far below the return expectations for shareholders, which means shareholders like dividend, everyone likes cash, but shareholders are really in it for the long-term appreciation for the company. All right, now we talked about sensitivity. So we just played with the two variations in the denominator of that future value, which is return required for shares and the growth rate. And we're here in the center of this sensitivity chart at 13% required return and 6% growth. We see that as growth changes, it goes up by 1%, there's a jump in value. However, it goes the other way. As growth goes down, there's a big drop in value. As we move left and right along 6%, as the required return drops, the value jumps, right? If the WACC were somehow to be reduced, we then would be generating more excess returns. And then the right side is what happens if it goes the other way. If required return rises, what happens? So small changes can have large impact. And what we like to see as a company is lower required returns and higher long-term growth rates. So here it is, lower required returns right here, higher growth rates right there. Okay, good. Next, we'll look at some observations. If you look at DDM as explaining price, then there's some assumptions that are a bit of a problem here. First is dividends are set by the company, and they may or may not reflect the underlying cash flow of the business. Furthermore, there's a perception in the market about dividends, and those expectations could have some impact on the stock price. Furthermore, if most of the stock value is due to long-term cash flow, then why do managers focus on quarterly earnings? The answer is that there's signaling involved, is that we believe that with a small increase in dividends, that creates a signal to the marketplace that the company is bullish about its future. It feels comfortable increasing its somewhat fixed obligation, or at least commitment, to try to pay same or more dividends in the future. So managers have an incentive to have the market perception rise for the stock, because if they have stock options, or if they have bonus programs that are also tied to company performance, it would have that impact. So DDM is a fairly simple method in terms of the math. However, its practicality in business is not as strong. It's limited to mature companies, and also companies which are not prone to wide variations in dividend policy or change in dividend policy.